from Australia asked about margin of safety, and you replied that a superior business may not require that much of a margin of safety. I'm very curious how you come up with your discount rate and how you might adjust that discount rate based upon various businesses.
We don't formally have discount rates. I mean, every time I start talking about all this stuff, Charlie reminds me that I've never prepared a spreadsheet, but I do, in effect, in my mind, I do. But we are going to want to get a significantly higher return, obviously, in terms of cash produced relative to the amount we're outlaying now for a business than we are from a government bond. I mean, we're going to, that has to be the yardstick at a base. Then how much more do we want? Well, if government bond rates were 2%, we're not going to buy a business to earn 3 or 3.5% expectancy over the years. We just don't want to commit our money that way. We'd rather sit around and wait a little while. If they're 4.75%, what do we hope to get over time? Well, we want to get a fair amount more than that. But I can't tell you that we sit down every morning and I call Charlie in Los Angeles and say, what's our hurdle rate today? I mean, we have never used the term. It's a little bit of we want enough so that we feel very comfortable if they close on the stock market for a couple of years, if interest rates go up another 100 basis points or 200 basis points, we're still happy with what we bought. And above that, I really, I know it sounds kind of fuzzy, but it is fuzzy. Charlie?
Yeah, the concept of a hurdle rate makes nothing but sense. And yet a lot of terrible errors are made by people who are talking about hurdle rates. Just because you can measure something and guess it doesn't mean that it's the controlling variable in what you're dealing with in a messy world. And I don't think there's any substitute for thinking about a whole lot of investment options and thinking about why one is better than another and what the likely returns are from each, et cetera, et cetera. And the trouble with the hurdle rate concept, not that we don't have one in a sense, is that it doesn't work as well as a system of comparing things. In other words, if I have something available that I think will give me 8% for sure, and I can buy all I want of it, and you've got a perfectly good investment that I think will earn 7%, I don't have to waste 5 minutes with you. You're like the mail order service offering the bride through the mail and she's got AIDS. I can go on to some different subject. And so the concept of opportunity cost it's so little taught in investment. They teach it in the freshman course in economics in all the major universities, but when you get to the corporate finance departments and so forth, it doesn't lend itself to the kind of mathematics they want to use, so they ignore it. But in the real world, your opportunity costs are what you want to make your decisions based on.
Yeah, and even if you had something that you were really familiar with and were very sure on the 8%, 8.5 wouldn't tempt you if somebody came along. That's a practical matter.
Sure.
I've been on, as I mentioned, I've been on 19 corporate boards. I would say that of the presentations I've seen, and I've seen a lot of them, and every one of them had a calculation of internal rate of return. If they'd burned them all, the boards would have been better off. I mean, there is so much nonsense presented because the presenters essentially know what the listeners are desirous of hearing and what is needed in order to get through something that the CEO wants to do anyway. That you just get nonsense figures. And we may get nonsense figures too, but they're ours.
Let me give you an example of that. I have a young friend who sells private partnership interests to investors, and he's in a really tough field where it's hard to get decent returns. And I said, what return do you tell them you're aiming for? And he said, 20%. And he said, how did you pick that number? He said if I chose any lower number, they wouldn't give me the money.
And there's no one in the world we think can earn 20% with big money. I mean, it just, so anybody making a promise like that, basically we're going to write off immediately. It's amazing to me what, in a sense, how gullible big investors are, pension funds and so on, and that they have people come around and promise them the Holy Grail, and they want it so badly, that they're willing to believe things that just have to be nonsense.
The modern world, where people are trying to teach you how to come in and trade actively in stocks. Well, I regard that as roughly equivalent to trying to induce a bunch of young people to start off on heroin. It is really stupid. And when you're already rich, to make your money by encouraging people to get rich by trading. And then there are people on the TV, another wonderful place. And they say, I have this book that will teach you how to make 300% a year. And all you have to do is pay for shipping, and I will mail it to you. How likely is it that a person who had suddenly found a way to make 300% a year would be trying to sell books on the internet to you? And it's ridiculous. And yet, I've described modern commerce. And the people who do this all day think they're useful citizens. The advertising agents that invent the lingo. And so in insurance, they say, the two people who shifted from Geico to the Glotz Insurance Company save $400 each. What they don't tell you is there are only two such people in the whole United States, and they were both nuts. But they mislead you on purpose. And I get tired of it. And I don't think it's right that we deliberately mislead people as much as we do. Let me tell you another story that I think is an interesting one about the modern life. But this goes back to a different time. And this man has this wonderful horse. And it's just a marvelous horse. It's got an easy gait and good looking and everything. It just works wonderfully. But also occasionally just gets so he's dangerous and vicious and causes enormous damage and trouble and breaks arms and legs for his rider and so on. And he goes to the vet and says, what can I do about this horse? And the vet says, that's a very easy problem and I'm glad to help you. He says, what should I do? And the man says, the next time your horse is behaving well, sell it. Well, think of how immoral that is. And haven't I just described what private equity has to do? When private equity has to sell something that's really troublesome, they hire an investment banker. And what does the investment banker do? He makes a projection. You can't, I have never seen such expertise in my whole life as is created in making projections in investment banking. There is no business so lousy it can't get a wonderful projection. But is that a great way to make a living, to have phony projections and use it to make money out of people you look right into the eyes of? I would say no. And by and large, Warren and I, we never tried to make money out of stupidity of our dumb buyers. We tried to make money by buying. And if we were selling horse shit, we didn't want to pretend it was a cure for arthritis. And I think it's better to go through life our way instead of theirs. I think it's always been this way. I think there's always been chicanery. Think of the carnivals, the carny operator. Think how much trickery there is in a carny operation. And people just seek out the weaknesses of their fellow man and take advantage. And you have to get wise enough so you avoid them all. And you can't avoid them if they're in your family. I have no solution to that one. But where you have a fair choice, there are just so many people that should be avoided. My father had this best friend and client, and he also had this other client who was a big blowhard. And he was always working for the big blowhard, and he wasn't ever working for his wonderful client whom I admired. And I said, "Why do you do this?" And he said, "Charlie, you idiot." He says, "The big blowhard is an endless source of legal troubles. He's always in trouble, overreaching and misbehaving and so forth. Whereas Grant McFadden treats everybody right, the employees, the customers, everything. He gets involved with some psychotic, he walks over there and makes a graceful exit immediately. So a man like that doesn't need a lawyer." And my father was trying to teach me something, and it really worked. I spent my whole life trying to be like Grant McFadden. And I want to tell you, it works. It really works. Peter Coffin is always telling me if the crooks only knew how much money you could make by being honest, they'd all behave differently. Warren has a wonderful saying I like. He says, "You take the high road, it's never..."
Wondering if the current economic stresses remind you of any prior period in U.S. or any other nation's history, and if so, is there anything we can learn from the prior period that might help us manage the current period better?
Well, they're all a little different and they all have similarities, but this one obviously had more of its origins in the mortgage field and in terms of the residential real estate bubble. But the troubles that begin in one area have a way of spreading to other areas. But I would say that in my lifetime, I can't remember one where this particular residential real estate bubble has sent out the shock waves and the exposure of other practices elsewhere as to their weaknesses like this one. But I don't think there's any magic to the analysis or anything like that. I think that some stupid things were done that won't be done soon again, and they won't be done exactly the same again, but variations of them will pop up at some point, because humans are what lead to stupidity and behavior, and there are these sort of primal urges that in terms of getting rich and using leverage and all of that sort of thing and wanting to believe in the tooth fairy, and that pop up from time to time in human behavior, and sometimes they pop up on a very big scale. In terms of having any great insights on solutions or anything of the sort, I don't have them. Charlie?
Well, no, but it was a particularly foolish mess. Now, at earlier meetings, we talked about some idiot who decided that a credit delivery grocery business like the old Buffett store, a web van, internet-based delivery service for groceries, a really asinine idea. And of course, it met an ignominious failure. That was smarter than what the people did in this mortgage field. It was a lot smarter. I just wish we had those brilliant people back that gave us Webvan. Which, by the way, reminds me of my general attitude toward political developments. I have a rule, and it's as follows. The politicians are never so bad you don't live to want them. It is, I'm higher on the existing social order than you are. There's always plenty wrong with a social order, and certainly there are places where ours is a lot more broken than it used to be. I don't think Warren and I have any wonderful solution to all the problems of the world, but wishing for $1 million instead of some more tangible short step is the wrong frame of mind. That isn't the way we got our $1 million.
Yeah. But I don't.
Warren might give a different answer, by the way. He's
No, I would agree with the wishing for a job. Makes a lot of sense to me, and figuring out how to get one and then going from there. But there is, and always has been. That doesn't mean it always should be, but there is a tremendous amount of inequality. What you don't want is an inequality of opportunity. There will be a lot of inequality in ability. A market system like we have turns out what people want. If they want to watch a heavyweight fight and they want to watch Mike Tyson, they're going to pay him $25 million for getting in the ring for a few minutes. And it produces what people like, and it produces in an abundance, and it's done very well in terms of production. It is much better to be in the bottom 20% in this country now than it was 50 years ago, and it's better to be in the bottom 20% of this country than in any other country. But it still isn't very satisfactory. The market system does not reward teachers, it does not reward, it does not reward all kinds of people who do all kinds of useful things in any way comparable to how it will reward entertainers or people who can figure out the value of businesses or athletes or that sort of thing. A market system pays very big for something that will entertain them. People want to be entertained a good bit of the day, and pays better for people that will entertain and educate. I don't want to tinker with the market system. I don't think I should be telling people what they should want to do with their lives, but I do think that it's incumbent on the people that do very well under that system to be taxed in a manner that takes reasonable care of anybody that is not well adapted to that system, but that it's a perfectly decent citizen in every other regard. And that is, I don't want to start getting into comparable worth in terms of how I tax, but I do think that somebody like me that happens to just fit this system magnificently, but wouldn't be worth a damn in Bangladesh or someplace, because what I have wouldn't pay off there. Their system would not reward that. I think that we get from society. This society provides me with enormous rewards for what I bring to the game. And it does the same with Mike Tyson, and it does the same with some guy whose adenoids are right for singing or whatever it may be. And I don't want to tamper with that, but I do think those people who are getting all kinds of claim checks on the rest of society from that, I think there should be a system where people who are not well adapted to that system, but that are perfectly decent citizens in every other respect, do not really, fall through the slats on that. And I think progress has been made on that over the last 50 years, but I think we're far from a perfect society in that respect. And I hope, more progress is made in the next 50 years. I don't think the wishing for the $1 million, though, is it doesn't work that way. And I think, but if you are lucky enough to have something that the market system rewards, you do very well here. And if you're unlucky enough to have something it doesn't reward, you do better now than you would have 30 or 40 years ago, and you do better than in other countries. But I can see where it seems very unjust to look at somebody else who has just a little different mix of talents that can achieve claim checks in a way that keeps them and the next 5 generations of their family in a position where they don't have to do very much.
I would say that I like a certain amount of social intervention that takes some of the inequality out of results in capitalism. But I hate with a passion rewarding anything that can be easily faked, because I think then people lie, and lying works, and the lying spreads, and I think your whole civilization deteriorates. If I were running the world, the compensation for stress under workman's compensation would be 0. Not because there isn't real stress, because there's no way to keep the fakery out if you reward stress at all.
There was a great article, and this applies to an earlier question. There was a very good article in Forbes about 1 issue ago that showed the occupational profile of the U.S. At a couple of different intervals going back to 1900. And one problem you can see just by looking at that profile is that if you assume 20% of the bottom 20%, however you measure it in terms of employability, whether it's measured by IQ or interest in working or energy level or whatever you want to do, they fit very well most of the jobs that were available 100 years ago. In other words, you could do most of the jobs, of which there were many, with relatively unimpressive mental abilities. And as jobs have changed, the profile of people hasn't changed. So there are more people that end up on the short end. Now, the good part of that is the society produces so much more that it can take care of those people one way or another. Now, the trick is to take care of them and make them not only feel, but be productive and be part of the act. And we've got enough product to do that, but the country turns out way more output than 50 or 100 years ago. We're not perfect at figuring out how to make the bottom 20 or 30% in terms of abilities fit a new changing job profile. I really recommend you look at that Forbes magazine, because if you think through the implications of those charts, I think you'll see what social problems have to be attacked.
It's amazing how if you just get up every morning and keep plugging and have some discipline and keep learning, and it's amazing how it works out okay. I don't think it's wise to have an ambition to be president of the United States or a billionaire or something like that, because the odds are too much against you. Much better to aim low. I did not intend to get rich. I wanted to get independent. I just overshot. And and by the way, while you're clapping, some of the overshooting was accidental. There's a big, you can be very deserving and very intelligent and very disciplined, but there's also a factor of luck that comes into this thing. And the people who get the outcomes that seem extraordinary, they're the people who have discipline and intelligence and good virtue, plus a hell of a lot of luck. Why wouldn't the world work like that? So you shouldn't give credit for the onion.
Can't really fail at it unless you buy the wrong stock or just get excited at the wrong time. And I would like to just spend just a couple of minutes giving you a little perspective on how you might think about investments as opposed to the tendency to focus on what's happening today or even this minute as you go through. And to help me in doing that, I'd like to go back through a little personal history, and we will start. I have here a New York Times of March 12th, 1942. I'm a little behind on my reading. And if you go back to that time, it was just about 3 months since we got involved in a war which we were losing at that point. The newspaper headlines were filled with bad news from the Pacific, and I've taken just a couple of the headlines from the days preceding March 11th, which I'll explain. It's kind of a momentous day for me. And so you can see these headlines. We've got slide 2 up there, I believe. We were in trouble, big trouble, in the Pacific. It was only going to be a couple months later that the Philippines fell, but here we were getting bad news. We might go to slide 3 for March 9th. I hope you can read the headlines anyway. The price of the paper is 3 cents, incidentally. Let's see, we've got March 10th up there, a slide. When I get to this advanced technology of slides, I want to make sure I'm showing you the same thing that I'm seeing in front of me. So anyway, on March 10th, when again, the news was bad. Full clearing path to Australia. And it was like, the stock market had been reflecting this. And I'd been watching a stock called City Service Preferred Stock, which had sold at $84 the previous year. It had sold at $55 the year before, early in January, 2 months earlier. And now it was down to $40 on March 10th. So that night, despite these headlines, I said to my dad, I said, I think I'd like to pull the trigger. And I'd like you to buy me three shares of City Service Preferred the next day. And that was all I had. I mean, that was my capital accumulated over the previous 5 years or thereabouts. And so my dad the next morning bought 3 shares. Well, let's take a look at what happened the next day. Let's go to the next slide, please. And it was not a good day. The stock market, the Dow Jones Industrials broke 100 on the downside. Now they were down 2.28%, as you see, but that was the equivalent of about a 500-point drop now. So I'm in school wondering what is going on, of course. Incidentally, you'll see on the left side of the chart, the New York Times put the Dow Jones Industrial Average below all the averages they calculated. They had their own averages, which have since disappeared, but the Dow Jones has continued. So the next day, we can go to the next slide, and you will see what happened. The stock that was at 39, my dad bought my stock right away in the morning because I'd asked him to, my 3 shares. And so I paid the high for the day. That 38 and a quarter was my tick, which is the high for day. And by the end of the day, it was down to 37, which was really kind of characteristic of my timing in stocks that was going to appear in future years. But it was on what was then called the New York Curb Exchange, then became the American Stock Exchange. But things, even though the war until the Battle of Midway looked very bad, and if you'll turn to the next slide, please, you'll see that the stock did rather well. You can see where I bought it, 38 and a quarter. And then the stock went on actually to eventually be called by the City Service Company for over $200 a share. But this is not a happy story, because if you go to the next page, you will see that well, as they always say, it seemed like a good idea at the time. So I sold. I made $5 on it. It was again typical of behavior. But when you watch it go down to 27, it looked pretty good to get that profit. Well, what's the point of all this? Well, we can leave behind the City Service story, and I would like you to again imagine yourself back on March 11th of 1942. And as I say, things were looking bad in the European theater as well as what was going on in the Pacific. But everybody in this country knew America was going to win the war. I mean, it was, we'd gotten blindsided, but we were going to win the war, and we knew that the American system had been working well since 1776. So if you'll turn to the next slide, I'd like you to imagine that at that time you had invested $10,000, and you put that money in an index fund. We didn't have index funds then, but you in effect bought the S&P 500. Now I would like you to think a while, and do not change the slide here for a minute. I'd like you to think about how much that $10,000 would now be worth if you just had one basic premise, just like in buying a farm, you buy it to hold throughout your lifetime and you look to the output of the farm to determine whether you made a wise investment. You look to the output of the apartment house to decide whether you made a wise investment if you buy an small apartment house to hold for your life. And let's say instead you decided to put the $10,000 in and hold a piece of American business and never look at another stock quote, never listen to another person give you advice or anything on the sort. I want you to think how much money you might have now. And now that you've got a number in your head, let's go to the next slide and we'll get the answer. You'd have $51 million and you wouldn't have had to do anything. You wouldn't have to understand accounting. You wouldn't have to look at your quotations every day like I did that first day. I'd already lost $3.75 by the time I came home from school. All you had to do was figure that America was going to do well over time, that we would overcome the current difficulties, and that if America did well, American business would do well. You didn't have to pick out winning stocks. You didn't have to pick out a winning time or anything of the sort. You basically just had to make one investment decision in your life. And that wasn't the only time to do it. I mean, I could go back and pick other times that would work out to even greater gains. But as you listen to the questions and answers we give today, just remember that the overriding question is, how is American business going to do over your investing lifetime? I would like to make one other comment because it's a little bit interesting. Let's say you'd taken that $10,000 and you'd listen to the prophets of doom and gloom around you, and you'll get that constantly throughout your life. And instead you'd use the $10,000 to buy gold. Now for your $10,000, you would have been able to buy about 300 ounces of gold. And while the businesses were reinvesting in more plants and new inventions came along, you would go down every year and look in your safe deposit box, and you'd have your 300 ounces of gold, and you could look at it, and you could fondle it, and you could, whatever you wanted to do with it. But it didn't produce anything. It was never going to produce anything. And what would you have today? You would have 300 ounces of gold, just like you had in March of 1942, and it would be worth approximately $400,000. So if you decided to go with a non-productive asset, gold, instead of a productive asset, which actually was earning more money and reinvesting and paying dividends and maybe purchasing stock, whatever it might be, you would now have over 100 times the value of what you would have had with a non-productive asset. In other words, for every dollar you have made in American business, you'd have less than a penny of gain by buying in the store of value, which people tell you to run to every time you get scared by the headlines or something of the sort. It's just remarkable to me that we have operated in this country with the greatest tailwind at our back that you can imagine. It's an investor's haven. You can't really fail at it unless you buy the wrong stock or just get excited at the wrong time. But if you own a cross-section of America and you put your money in consistently over the years, there's no comparison against owning something that's going to produce nothing. And frankly, there's no comparison with trying to jump in and out of stocks and pay investment advisors. If you'd followed my advice, incidentally, or this retrospective advice, which is always so easy to give, if you'd follow that, of course, there's one problem about it. Your friendly stockbroker would have starved to death. And you could have gone to the funeral to atone for their fate. But the truth is, you would have been better off doing this than a very, very, very high percentage of investment professionals have done, or people have done that are active. It's very hard to move around successfully and beat really what can be done with a very relaxed philosophy. And you do not have to know as much about accounting or stock market terminology or whatever else it may be. or what the Fed is going to do next time and whether it's going to raise rates 3 times or 4 times or 2 times. None of that counts at all, really, in a lifetime of investing. What counts is having a philosophy that you stick with, that you understand why you're in it, and then you forget about doing things that you don't know how to do.
Someone who visited the New York Stock Exchange at a very early age and have been touting its merits over the years. Could you comment a little bit about what you think of the shenanigans going on currently?
Well,
Warren, you're so good at this.
I personally think it would be better if the New York Stock Exchange remained as a neutral, and it's not strictly a nonprofit, it earns some money, but as a not for big profit, we'll put it, institution. I mean, the exchange has done a very good job over centuries. It's one of the most important institutions in the world, and the enemy of investment performance is activity. And the creator of profit in a profit-minded exchange is activity. So I personally would rather not have an exchange which is trying to increase its earnings per share annually and thereby wanting to encourage people to trade more actively and create more income for itself. That will not be, in my view, good for the American investor. So I think that the exchange of yesterday may be better for the American investor than what looks like it may be the exchange of tomorrow. Now, there may be all kinds of reasons that people find compelling why they want to turn it into a for-profit exchange. But I know the American investor will not be better off if volume doubles on the New York Stock Exchange, and I know that the New York Stock Exchange, as a for-profit institution, would be trying to figure out ways to have that volume increase and to perhaps even charge more money one way or the other. I mean, the profit of an exchange, the profit of the people working on it, in a sense, that's the frictional cost of capitalism. That's coming out of the earnings of the businesses. And, IBM or General Motors or General Electric will not earn more money because their stock turns over more frequently. But a for-profit exchange will earn more money. And I do not like the idea of the exchange getting on the side that's against the long-term interests of investors. Charlie?
Well, I feel on this one the same as you do, but much more strongly. I think we have lost our way when people like the governors of the stock exchange and the CEO fail to realize that they had a duty to the rest of us to act as is exemplars. There was of the right behaviors. Once your activity is that freighted with public significance, I think you've got a duty to create the right appearances. You have a duty as an exemplar. I mean, you do not want your first grade school teacher to be fornicating on the floor or drinking booze in the classroom, and similarly, I don't think you want your stock exchange to be all over the headlines with wretched excess. And I certainly don't think you want to turn the major stock exchange of the country into even more of a casino than it is already. I think we have totally lost our way on this stuff. And I agree with Warren that it ought to be a public institution that cares deeply about its duties as exemplar.
wish I'd gone to first grade where he did.
Question is, if I have a lifetime ahead of me where I want to keep an investment for more than 20 or 30 years, is it better to wait a year or two to see if the market crashes and prices drop, or to get in now and just stay with it over a long time horizon?
In general terms, unless you find the prices of a great company really offensive, if you feel you've identified it, and by definition, a great company is one that's going to remain great for 30 years. If it's going to be a great company for 3 years, it ain't a great company. I mean, so you really want to go along with the idea of something that if you were going to take a trip for 20 years, you wouldn't feel bad leaving the money in with no orders with your broker and no power of attorney or anything, and you just go on the trip and you come back and it's going to be a terribly strong company. I think it's better just to own them. I mean, we could attempt to buy and sell some of the things that we own that we think are fine businesses, but they're too hard to find. I mean, we found See's Candy in 1972, where we find here and there we get the opportunity to do something, but they're too hard to find. So to sit there and hope that you buy them in the throes of some panic, that you sort of take the attitude of a mortician, waiting for a flu epidemic or something. I mean, I'm not sure that will be a great technique. I mean, it may be great if you inherit it. Paul Getty inherited the money at the bottom in 32. I mean, he didn't inherit it exactly. He talked his mother out of it, but yeah. It's true, actually.
Close enough.
Yeah, close enough, right? But he benefited enormously by having access to a lot of cash in the early 30s that he didn't have access to in the late 20s, and so you can get some accidents like that. But that's a lot to count on, and if you start with the Dow at X and you think it's too high. When it goes to 90% of X, do you buy? Well, if it does and it goes to 50% of X, it gets, you never get the benefit of those extremes anyway, unless you just come into some accidental sum of money at some time. So I think the main thing to do is find wonderful businesses. Is Phil Carre here? We got the world. Yeah, there's the hero of investing. Phil, would you stand up? Phil is 99. He wrote a book on investing in 1924. Phil has done awfully well by finding businesses he likes and sticking with them and not worrying too much about what they do day to day. There's going to be I think there's going to be an article in the Wall Street Journal about Phil on May 28th, and I advise you all to read it. You'll probably learn a lot more with him by coming to this meeting, but it's that approach of buying businesses. I mean, let's just say there was no stock market, and the owner of the best business in whatever your hometown is came to you and said, "Look, my brother just died, and he owned 20% of the business, and I want somebody to go in with me to buy that 20%, and the price looks a little high, maybe, but this is what I think I can get for it. Do you want to buy in?" I think if you like the business and you like the person who's coming to you and the price sounds reasonable and you really know the business, I think probably the thing to do is to take it and don't worry about how it's quoted. It won't be quoted tomorrow or next week or next month. I think people's investment would be more intelligent if stocks were quoted about once a year, but it isn't going to happen that way. So, and if you happen to come into some added money at some time when something dramatic has happened. I mean, we did well back in 1964 because American Express ran into a crook. We did well in 1976 because Geico's managers and auditors didn't know what the loss reserve should have been the previous couple of years. So we've had our share of flu epidemics, but you don't want to spend your life waiting around for them.